We're going to continue with the Pharrell problem. So we've already done journal entries. We posted those to the ledger. Then we did a trial balance to make sure our debits and credits are correct and balanced. So our next step is to do adjusting journal entries to get everything in the correct period. Notice in this problem, we're making adjusting journal entries for the end of January. So we're doing them monthly. Be careful in problems. It clearly makes a difference if you're making adjustments once a month or once a year. So we're going to do them monthly. Since the first thing we did was purchase that building, we're going to do the depreciation. The order in which you do the things really make no difference at all, though. But we'll do the depreciation first. We bought it for $51,000. That happened one of the very first journal entries we did. But then we have to estimate how many years we're going to use it. So we're just guessing we'll use it for 25 years. I want to take that 51,000 and divide it by 25 years times 12 months, because we're doing this monthly. It's $170 per month. My journal entry is always, with the debits first, depreciation expense and accumulated depreciation for the 170. And when you see depreciation, it will always be those two accounts: debit depreciation expense, credit accumulated depreciation. Remember, this accumulated depreciation is a contra asset account, meaning if we did our financial statements for January, which we're going to do in a little bit, we're going to take that $51,000 that we purchased the building for, subtract out 170, and that's the amount we still have left to depreciate over the remainder of that asset's life. We also bought some music equipment for $34,300, so we have to depreciate that as well. We have to estimate how long they'll last. The nice thing in problems, they have to give this to you because there's no way to really know. Most companies just have a policy. But let's say we're going to have that last 50 months. I left that in months, so that makes that a little easier. So it's $34,300 divided by 50. So that's $686 a month that I'll depreciate that. Here I can be a little bit sneakier because I don't want to have to type this again. Again, the accounts are always the same for depreciation. Don't overthink it. The only thing that will change is the amount has to be the 686. So that handles all the depreciation. When we bought that music equipment, we signed a loan. And so with loans, we usually have to pay interest. We're going to say the interest is $343 a month. That's a little pricey, but makes the numbers easy. I haven't done anything yet, but I owe that interest. And I'm going to pay that at the end of the loan period. I'm not going to pay it monthly. What I need to show is that I've got some interest expense that I haven't booked yet of the $343. And since it goes with a loan payable, that means this must be interest payable. We always keep our interest separate from the note itself for $343. If it's a note payable, you'll have interest payable. Occasionally, you'll have a receivable, and in that case, we would have interest receivables. Remember, we bought $200 worth of supplies, and we've been using them all through the month. And so let's say we go and we look at our cabinet and we say, oh, there's about $42 worth of supplies still in that cabinet. So that means if we started with 200 and now we've got 42, we must have used $158 worth of those supplies. Usually we don't keep track of every time somebody uses a pencil what should be an expense. We just wait to the end and estimate what's left. If we've used something, we know the name of that is an expense. Supplies expense is our debit. And then what we want to reduce is that supplies asset account. When we're done, if we look at this, we had 200 in the supplies account. I took out 158. I'll let you do that on a piece of scratch paper, but you better come up with that. Leaves with $42 in that supplies account, which is what our asset is at this point in time. On this next entry, I'm going to change up things a little bit from what we did in those original journal entries. In the original journal entries, we paid rent of $1,100. And I said it was just for January, so we took it to rent expense. What I'm changing here is now that rent for $1,100 is for January and February. So since I'm paying in advance for more than 1 month, I want to put it into an account called prepaid rent, because if it's going to expire in a month, if it doesn't really make any difference where I put it. But if it's going more than one period, you need to show that you've done an asset, you paid in advance. So that's $1,100, but now it's for January and February. So only half of that should be an expense and the other half should be an asset. So my prepaid rent has to go down. To reduce your prepaid rent, you're going to have to credit it. And so the debit that's what we've used up. So that's rent expense. I've got $550 of rent expense for January, and I've got an asset for February that I'll expense out next month. I had that $2,200 worth of payroll that I paid people last week. But now comes the end of the month, and let's say January ends on a Wednesday. So now people have earned 3 days worth of salary, but I haven't paid them yet. Again, my $2,200, I'll do it this way, divided by 5, gives me $440 per day. And so I want to take that times 3. So I owe them $1,320 for the amount they've worked this month. If I've used up their services, it has to be an expense. So salaries, you can call it wage expense. Depends on if you think these are people paid by the hour or paid on a salary. The $1,320. And I owe them, so that's salaries, generally whatever you called it up above. But now it's a payable because I owe them. If you notice in all of these entries, one of the accounts is on the income statement and the other account is on the balance sheet. And that's true of all the entries we've made. So then our last one is on December 31st. Let's say a university brought in a bunch of instruments to be repaired, and they come in and pick them up. So they'll have them for their New Year's Day parade. So they pick up their instruments. Pharrell gives them a bill for $2,900 or an invoice, and the university is going to pay it in January. They're going to give it to accounts person, and they'll take care of it. Obviously, Pharrell partied on New Year's Eve, so he didn't make a journal entry for that transaction. So we have to, because if they picked it up on the 31st, that's revenue in that year. So remember, revenue is a credit. So we need revenue or sales, whichever one you like, for the $2,900. The people haven't paid for it yet. So that means it's an accounts receivable for the $2,900. And those are our adjusting journal entries that we have to make.